Recently, I wrote about how the cycles pointed out by Kuznets, Kondratyev, and Minsky, combined with the writings of Joseph Schumpeter, seem to be coming together at the same time. Now that the war in Iran is 2 months old, it seems the match has been lit that will set the frightening confluence ablaze. It sure looks like we're in a credit bubble that's beginning to burst. The challenge when writing about major developments is to sound calm and purposeful when the natural inclination might be to more animated. How to get people to take urgent action without coming across as an over-the-top doomsayer. To begin, I need to stress that I do not see myself as a pessimist. I've been speaking to college students throughout Southern Ontario for the past few months, and when I tell them about something I call bullshift, which is the optimism bias fomented by the financial services industry, they often ask if I'm not being biased and overly gloomy. I respond with both the evidence and by conceding that everyone has biases, so their allegations against me, while not incorrect, are nonetheless likely to be overstated. My view is that better wealth decisions are made using facts, critical thinking, and a dash of skepticism regarding the finance industry's motives. There are a couple of indicators that are now showing credit markets in a state of high stress. The longer the war in Iran persists, the worse the situation is likely to become. As such, here are a few things you should do immediately to reduce your exposure to credit. Number one, if you haven't already done so, build an emergency fund. Many people use the equity in their home for this. And the caveat here is that real estate prices are likely to drop in the short term as well, so be careful. Where possible, consider setting aside money in a high-yield savings account for emergencies. And when you're financially cushioned, you're less likely to rely on more punitive alternatives when the money is tight. Second, pay down high-interest debt and avoid new debt. Do this by using either the preferred cascade method, which is where you pay the highest interest rate debt first, or alternatively the snowball method, which is where you pay the smallest balance first. But either way, stop using credit cards for non-essential purchases. Buy only what you absolutely need. 3. Lower credit utilization and automate timely payments. Aim to keep card balances well below credit limits. Set up automatic payments and pay as much as you can when the bill comes due. And if necessary, you can even request a credit limit increase, which can lower utilization, or spread purchases across multiple cards. Fourth, this is only for some people, but you may consider placing a freeze or fraud alert with major credit card bureaus if you suspect there's any kind of fraud. Enable the wallet or mobile alerts for new accounts or unusual activity. That keeps your credit clean and prevents fraudulent debt from inflating your exposure. And then finally, consider debt consolidation or refinancing. Compare options like a personal loan or a credit consolidation. Calculate total costs, rates, fees, and promo periods versus your current debt. Use the savings to pay those balances down faster and, of course, again, avoid taking on new debt. It looks very much like the world is headed to a recession. At the minimum, the past bull market in financial assets was fueled by easy credit, and that tailwind looks almost certain to become a headwind soon. For over 40 years, from 1981 to 2022, interest rates, which is to say the price of money, fell. Lower rates meant higher leverage. Higher leverage, in turn, meant higher asset prices. Now, with rates going up, affordability is dropping, as is demand. The Canadian economy, which is to say Canadian citizens, are highly leveraged. It's become imperative to deleverage before the market does it for you. The same is true in the US, only there the problem lies mostly with government debt, which recently surpassed $39 trillion. In addition, the US 20-year Treasury note yield just passed 5%. The trade impacts of the Iranian war look very much like a geopolitical own goal, creating the onset of a self-inflicted credit event. Time is short. If you can, please deleverage immediately.